The dictionary meaning of the word risk is the probability of suffering from an injury, damage, or loss. It has the connotation of danger to life and limb. No wonder when investors hear the word risk, they conjure up images of physical danger and possibly have a disproportionately negative reaction. I wonder whether that is the reason why most of us are risk averse. These risk averse people then have all their investments in bank deposits or government fixed investment schemes. Little do they realize that after adjusting for inflation, they hardly make any money on these investments. In fact, sometimes they lose money. They need to ponder over the question whether is it not a risk when these investments do not earn enough returns to fulfill their financial goals. Is it not a bigger risk that their retirement money may run out before they die? So let us examine what exactly do we fear when we say we are risk averse. It has been established beyond doubt that growth assets like equity provide a decent inflation adjusted return over time. But in the intervening period, the prices fluctuate. They go up and down. It is the downs that the investors fear, to such an extent that they would just want to get rid of the investment. You have to view these fluctuations with the right perspective. It is just the prices going up and down over the shorter term. But if you take a long-term view, you will see the graph sloping upwards. Besides, price fluctuation is a part of life. The prices of petrol fluctuates, prices of your daily foodstuff like vegetables and milk fluctuate. Even the prices of the clothes you wear will come down when there is an annual sale. Do you get scared then? No. On the contrary, you rush to buy more because it is cheap. So why are you so scared when the prices of stock come down? Even after knowing the above facts and acknowledging them to be true, some of you will still hesitate to wholeheartedly embrace the concept. This may be due to an inherent trait in your personality called your risk tolerance. In the context of investing and managing money, there are three aspects of risk to be considered. Number one is the risk tolerance. It is the level of risk a person prefers to take. It is a psychological trait which does not change easily. However, it is important to note that perception of risk determines the risk tolerance. If you do not know about a particular investment product, you will be wary of it. So, although risk tolerance is a psychological trait, with understanding of the product, it can change. Risk capacity. It defines the amount of risk a person can afford to take. This depends on his financial situation like stability of income, his assets, liabilities, and his financial goals. Risk required is the third aspect of risk. It defines the amount of risk a person needs to take. For example, most wealthy people have goals of wealth conservation or retention than significant returns. These are the people who are not required to take much of risk. In this context, the role of your financial advisor is paramount. There would be times when risk required would be more than the risk tolerance of the individual. The onus would be on the financial advisor to gently demonstrate to the investor that the risk that is being perceived is nothing but the fear of price fluctuation, and the real risk is that of not fulfilling your defined financial goal or outliving your retirement money. So in conclusion, do be aware of the risks involved in each investment product and understand your risk tolerance levels. But you need to balance the urge to remain within your risk tolerance with the necessity to achieve financial security. Consult a qualified financial advisor. Thank you for watching.